What if you wake up tomorrow morning and your dollars are worth 30% less? Your savings account, your paycheck, your 401k, all instantly weaker. Gas stations refusing cash, ATMs limiting withdrawals, the stock market frozen. Sounds extreme? In 2026, the U.S. national debt is over $36 trillion. Interest payments alone are above $1 trillion per year, and global confidence is wobbling. If the U.S. dollar collapsed overnight, it wouldn't just be a headline. It would hit your rent, your groceries, your job. So today, we're breaking down exactly what would happen, how realistic it is, and most importantly, what you should be doing with your money right now. Let's start with what a dollar collapse actually means. It doesn't mean paper money disappears. It means global trust disappears. Right now, in 2026, the US dollar still makes up roughly 58% of global foreign exchange reserves. That's down from about 70% 20 years ago. Countries are slowly diversifying, adding gold, euros, and even Chinese yuan to reserves, but the dollar is still king. Why? Because it's the world's reserve currency. Oil is priced in dollars. Global trade is settled in dollars. U.S. Treasury bonds are considered the risk-free asset. But here's the problem. The U.S. national debt has crossed $36 trillion. Interest payments alone now exceed $1 trillion annually, more than the entire defense budget. Think about that. We're borrowing money just to pay interest on money we already borrowed. Now, imagine foreign governments like China, Japan, or oil-exporting nations suddenly deciding they don't want to hold dollars anymore. They start selling U.S. Treasury bonds. The dollar weakens fast. Investors panic. Capital flees. Currencies collapse when confidence collapses. It's not math first, it's psychology first. Look at Argentina. Look at Turkey. Hyperinflation didn't start because people woke up one day and inflation was 500%. It started because trust broke. Now, is the US Argentina? No. The US has the largest economy in the world at around $29 trillion GDP in 2026. It has military power. It controls the global financial plumbing. But even empires aren't immune to debt cycles. So the real question isn't, is it likely tomorrow? The real question is, if confidence cracked, how fast could things spiral? And if it did, what would that mean for you? Let's walk through a hypothetical overnight collapse. Day 1, the dollar drops 20 to 30% against major currencies. Markets halt trading. Banks limit withdrawals. The Federal Reserve steps in with emergency liquidity. News anchors look shaken. Imports instantly become more expensive. And remember, the US imports a massive portion of consumer goods, electronics, clothing, auto parts, pharmaceuticals. If the dollar weakens 30%, those goods effectively cost 30% more. Gas prices spike. Oil is priced globally, and if foreign producers demand stronger currencies, Americans pay more at the pump. Week 1, inflation expectations explode. If people think prices will rise tomorrow, they buy today. That creates shortages. That creates panic buying. That accelerates inflation. It's a self-fulfilling loop. Your savings account earning 3 to 4% interest? Meaningless if inflation hits 15 or 20%.
Month 1. Businesses with international supply chains struggle. Companies with heavy debt get crushed by rising interest rates. The stock market could drop 40% or more in a severe confidence crisis. Retirement accounts take a hit. Unemployment rises as companies cut costs. Credit tightens. Mortgages and car loans become harder to get. Now pause. Does this mean total Mad Max chaos? Probably not. The US government would deploy every tool available. Emergency rate hikes, capital controls, swap lines with allies, possibly even temporary restrictions on large currency transfers. But here's the key. Even without total collapse, a sharp dollar crash would redistribute wealth violently. Savers in cash lose. Debtors with fixed-rate loans might win. Hard assets could surge. So the real question becomes, where would money run? Let's talk about history. In 1971, when President Richard Nixon ended the gold standard, the dollar lost over 50% of its value against gold during the 1970s inflation era. Inflation peaked above 14% in 1980. In 2008, during the global financial crisis, the system didn't collapse, but trillions were printed. The Federal Reserve's balance sheet went from under $1 trillion pre-2008 to nearly $9 trillion at its peak after COVID. Every crisis leads to more liquidity, more debt, more monetary expansion. In 2026, we're sitting on record global debt levels, over $310 trillion worldwide. That's more than 3 times global GDP. debt works beautifully until interest rates rise. So where does money historically run during currency fear? Gold. In the 1970s, gold rose from $35 an ounce to over $800. In recent years, gold has again been making new highs as central banks buy aggressively. Bitcoin. Whether you love it or hate it, it was created after 2008 as a response to central bank money printing. In currency crises globally, capital often seeks digital or portable assets. Real assets, farmland, real estate, energy infrastructure, things that produce value regardless of paper currency. But here's the twist most people miss. During panic, everything can fall at first. Even gold dropped briefly in 2008 because people needed liquidity. So don't assume there's a magical asset that only goes up. Markets move in waves. Liquidity first, repricing second, recovery third. And this brings us to the most important part, what you should actually do. First, don't panic. Panic is the fastest way to destroy wealth. Second, diversify currency exposure. If all your money is sitting in US cash, consider partial exposure to international assets. That could mean international ETFs, multinational companies, or even holding some foreign currency exposure indirectly through global funds. Third, own some hard assets. That doesn't mean sell everything and buy gold coins tomorrow, but having 5 to 15% of a portfolio in gold, commodities, or real asset funds can act as insurance. Fourth, control your debt. Fixed-rate debt during inflation can be powerful. Variable-rate debt during chaos can destroy you. If your mortgage is locked at 3%, inflation actually helps you. If your credit card is at 24%, you're vulnerable. Fifth, maintain liquidity. In any crisis, cash flow is oxygen. An emergency fund covering 6 to 12 months of expenses matters more than trying to time the market. Sixth, invest in pricing power. Companies that can raise prices during inflation tend to survive. Think essential goods, energy, utilities, strong global brands. And finally, invest in yourself. Skills that generate income in multiple currencies, remote capabilities, financial literacy. In uncertain times, flexibility is wealth. Here's the truth. A full overnight dollar collapse is unlikely because too many global systems depend on it. But a slow erosion, a steady decline in purchasing power, that's already happening. Inflation doesn't need to hit 50% to hurt you. Even 5 to 7% annually compounds brutally over time. So instead of asking, will the dollar die tomorrow, maybe the better question is my money positioned for resilience? If the US dollar collapsed overnight, it would be chaotic, painful, and destabilizing. Prices would spike, markets would crash, governments would intervene aggressively. But the people who survive and even thrive in these environments aren't the ones who predict perfectly, they're the ones who prepare intelligently. Debt is high, global tensions are rising, currency competition is real, but opportunity always hides inside volatility. You don't need to be afraid, you need to be positioned. So ask yourself right now, if the dollar dropped 30% tomorrow, would you be panicking or executing a plan? If this video helped you think differently about your money, hit like so more people see it. Subscribe for smart, no-hype breakdowns on finance in 2026. And in the comments, tell me, do you think the dollar's dominance is secure, or are we entering a new monetary era? Because the future of your wealth isn't about headlines, it's about preparation. And take care of your money. I'll be back soon.